Welcome to The Great Financial Story, a YouTube channel dedicated to exploring the most significant financial events in history. From financial bubbles and market crashes to economic booms and busts, we dive deep into the stories behind the numbers to give you a better understanding of how the financial world works. In this video, we will be discussing the 10 largest scams in financial history. Number 10 on our list is the Lehman Brothers Holdings Incorporated fraud. In 2010, it was revealed that Lehman Brothers Holdings Incorporated had been using accounting tricks to hide billions of dollars in debt, leading to billions of dollars in losses for investors. Lehman Brothers Holdings Incorporated was a global financial services firm that was founded in 1850. The company was involved in investment banking, asset management, and securities trading. In 2008, Lehman Brothers filed for bankruptcy, causing widespread financial turmoil and leading to billions of dollars in losses for investors. However, in 2010, it was revealed that Lehman Brothers had been using accounting tricks to hide billions of dollars in debt. The company had been using a practice called Repo 105, which allowed them to temporarily move debt off their balance sheets in order to appear more financially stable. This fraudulent activity contributed to the company's collapse and the loss of billions of dollars for investors. The Lehman Brothers bankruptcy and fraudulent activity had significant consequences for the global financial system, leading to a financial crisis and a worldwide economic recession. The collapse of Lehman Brothers also led to increased scrutiny and regulation of the financial industry. Number 9 is the Peregrine Financial Group Scandal. The Peregrine Financial Group Scandal, also known as the PFG Best Scandal, involved the misappropriation of customer funds by the company's CEO, Russell Weisendorf Sr. In 2012, it was discovered that Weisendorf had been embezzling millions of dollars from customer accounts for over 20 years. This led to the collapse of Peregrine Financial Group and the loss of billions of dollars for investors. The scandal came to light when Weisendorf attempted suicide and left a confession letter detailing his fraud. An investigation revealed that he had been using false documents and fake bank statements to cover up the missing funds. As a result of the scandal, Weisendorf was sentenced to 50 years in prison in order to pay over $215 million in restitution to victims. The collapse of Peregrine Financial Group also led to stricter regulations for the futures industry, including increased audits and improved customer protections. Number 8 is the Bank of Credit and Commerce International, BCCI, scandal. The Bank of Credit and Commerce International, BCCI, was a global bank founded in 1972 by Pakistani businessman Agha Hassan Abedi. It operated in 78 countries and had over 400 branches worldwide. However, in 1991, the bank was exposed for a wide range of illegal activities, including money laundering, bribery, and the financing of terrorism. It was discovered that the bank had been involved in a number of illicit activities, including the covert financing of arms deals, the financing of drug cartels, and the financing of illegal arms shipments to Iraq. The bank was also found to have been involved in the financing of the Mujahideen in Afghanistan, and it was discovered that the bank had been used to funnel money to the Palestine Liberation Organization, PLO. As a result of the scandal, the bank was shut down by regulatory authorities in a number of countries, and it was ultimately liquidated in 2002. The collapse of the bank caused billions of dollars in losses for investors and had a significant impact on the global financial system. Many people were left with significant financial losses as a result of the bank's collapse, and the scandal had far-reaching consequences for the global financial industry. 7th on our list is the Barings Bank collapse. The Barings Bank collapse was a financial scandal that occurred in 1995 and resulted in the bankruptcy of Barings Bank, one of the oldest and most prestigious banks in the United Kingdom. The collapse was caused by risky investments made by a single trader, Nick Leeson, who was working in the bank's Singapore office. Leeson had been making large bets on the Japanese stock market and hiding the losses in a secret account. When the market turned against him, the losses piled up and eventually led to the bank's bankruptcy. The total losses were estimated to be around $1.4 billion, which was a significant portion of the bank's total assets. The collapse of Barings Bank had significant consequences, including the loss of billions of dollars for investors, the loss of thousands of jobs, and damage to the reputation of the banking industry. Number 6 is the MF Global collapse. The MF Global collapse was a financial scandal that occurred in 2011. MF Global was a financial services firm that specialized in futures and options trading, as well as other financial products. However, in 2011, it was discovered that the company had been mismanaging customer funds, leading to the company's collapse and billions of dollars in losses for investors. One of the main factors that contributed to the MF Global collapse was the company's decision to invest heavily in European sovereign debt, which was considered risky at the time. When concerns about the stability of the European economy increased, the value of MF Global's investments plummeted, leading to significant losses for the company. In addition to the mismanagement of customer funds, it was also discovered that MF Global had been using accounting tricks to hide the extent of its financial troubles. This included falsely reporting the value of its assets and hiding significant losses from investors. The MF Global collapse had far-reaching consequences, leading to widespread financial turmoil and the loss of billions of dollars for investors. It also resulted in a series of investigations and legal proceedings, as authorities sought to hold those responsible for the collapse accountable for their actions. Fifth on our list is the Wells Fargo Fake Account Scandal. The Wells Fargo Fake Account Scandal was a major financial scandal that occurred in 2016. It was discovered that Wells Fargo employees had opened millions of fake bank accounts in order to meet sales targets and earn bonuses. These fake accounts were opened without the knowledge or consent of the customers, and many customers were charged fees for the fake accounts. The scandal came to light after the Consumer Financial Protection Bureau, CFPB, and the Office of the Comptroller of the Currency, OCC, fined Wells Fargo $185 million for the fraudulent practices. The scandal led to the resignation of Wells Fargo's CEO and the firing of thousands of employees. The Wells Fargo fake account scandal had a significant impact on the company's reputation and led to billions of dollars in fines and settlements. It also caused widespread outrage among customers and investors, leading to a decline in the company's stock price and a decrease in customer trust. To address the scandal, Wells Fargo implemented several reforms, including strengthening its internal controls and increasing oversight of its sales practices. The company also set up a program to compensate affected customers and implemented a new code of ethics for its employees. Number 4 is the Lehman Brothers Bankruptcy. The Lehman Brothers Bankruptcy was a financial crisis that occurred in 2008 when investment bank Lehman Brothers filed for bankruptcy. The company had been heavily invested in the subprime mortgage market, which collapsed due to a housing bubble. This led to Lehman Brothers being unable to pay off its debts and ultimately filing for bankruptcy, causing widespread financial turmoil. The bankruptcy of Lehman Brothers had a ripple effect on the global economy, leading to a credit freeze and a stock market crash. It also led to the loss of billions of dollars for investors and the loss of thousands of jobs. The bankruptcy of Lehman Brothers was a major contributor to the global financial crisis of 2008. Number 3 on our list is the WorldCom Scandal. The WorldCom Scandal, also known as the MCI WorldCom Scandal, was a financial scandal that occurred in 2002. WorldCom, a telecommunications company based in Mississippi, was accused of overstating its profits by $11 billion through the use of fraudulent accounting practices. These practices included hiding expenses and misclassifying expenses as capital investments, which artificially inflated the company's profits. The scandal was uncovered by internal auditors and later revealed to the public by the Securities and Exchange Commission, SEC. The revelation of the scandal caused the stock price of WorldCom to plummet, leading to billions of dollars in losses for investors. The company filed for bankruptcy in 2002, and several top executives, including CEO Bernard Ebbers, were eventually convicted of fraud and sentenced to prison. The WorldCom scandal had far-reaching consequences, including the loss of thousands of jobs and the collapse of the company's pension plan. It also contributed to the overall mistrust of corporate accounting practices and the implementation of stricter regulations, such as the Sarbanes-Oxley Act, which aimed to improve the accuracy and transparency of financial. Number 2 on our list is the Enron Scandal. The Enron Scandal, also known as the Enron Corpus Christi Scandal or the Enron debacle, was a financial scandal that involved the collapse of the energy company Enron Corporation in 2001. Enron, once a highly successful and respected company, was found to have fraudulently hidden billions of dollars in debt from its investors and financial statements. The company had created a complex web of shell companies and financial partnerships that were used to hide the true financial state of the company. Enron's financial fraud was uncovered in October 2001, leading to the company's bankruptcy and the loss of billions of dollars for investors. The scandal also resulted in the downfall of Arthur Andersen, one of the largest accounting firms in the world at the time, as they were found to have been complicit in Enron's financial fraud. The Enron scandal had far-reaching consequences, leading to the implementation of stricter regulations for publicly traded companies, including the Sarbanes-Oxley Act, which was passed in 2002 in response to the scandal. Many top executives at Enron, including CEO Jeffrey Skilling and CFO Andrew Fastow, were eventually convicted of fraud and other crimes related to the scandal. The Enron scandal remains one of the largest corporate frauds in history. And finally, the number 1 on our list is the Bernie Madoff Ponzi scheme. The Bernie Madoff Ponzi scheme is one of the largest and most well-known financial scams in history. Bernard L. Madoff, a former stockbroker and investment advisor, ran a massive Ponzi scheme that defrauded thousands of investors out of billions of dollars. A Ponzi scheme is a type of investment scam where earlier investors are paid returns with the money from new investors, rather than with profits from actual investments. This creates the illusion of a successful investment, and allows the scheme to continue as long as new investors are willing to contribute money. Madoff's scheme was particularly large and sophisticated, with many high-profile investors, including celebrities, trusts, and charitable organizations, being duped into investing with him. Madoff's firm, Bernard L. Madoff Investment Securities LLC, claimed to be a successful market maker and investment manager, but in reality, it was simply a front for Madoff's fraudulent activities. In December 2008, Madoff was arrested and charged with securities fraud. In March 2009, he pleaded guilty to 11 counts of fraud, including securities fraud, money laundering, and perjury. He was sentenced to 150 years in prison, and ordered to pay $170 billion in restitution to his victims. The Bernie Madoff Ponzi scheme caused widespread financial devastation, with many investors losing their entire life savings. It also led to increased scrutiny and regulation of the financial industry, as well as a loss of trust in the investment industry. Join us as we journey through the history of money and markets, and learn how the decisions of policymakers and investors have shaped the world we live in today. Whether you're a seasoned investor or just starting to learn about finance, there's something for everyone on the great financial story. Stay tuned for our upcoming videos, and don't forget to subscribe to our channel to stay up to date on the latest financial stories. Thanks for watching.